Okay, good afternoon and welcome back everyone to our education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay, and we have a very special event here this afternoon with Rick Bensignor, our Chief Market Strategist, where we're doing the first part of a series of webinars that we will be hosting together on technical analysis and giving you a deeper dive into our investment thesis and how we go about coming up with ideas and research for you as members here at OptionsPlay. And today we're going to be talking about one set of indicators that is at the core of Rick's work, which are the Demark Studies, and how we use them for specifically timing the markets and how we can potentially outperform the markets using these indicators. So, Rick, first of all, thank you so much for joining us this afternoon. And looking forward to talking with you today about these fantastic indicators that you use at the core of your work.
Sure, Tony. Thanks for having me.
Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. They are not a solicitation or recommendation to buy or sell any of the specific securities that we're going to discuss here today. Now, before we get started, I just want to announce one bit of housekeeping before we get into today's session, which is the Tuesday market macro outlook sessions that Rick hosts that we typically start at 9 a.m. Eastern time every single Tuesday. Starting March 1st, we're going to start those 15 minutes earlier at 8:45 due to some of the feedback that we've received from members about these sessions going right up to the open, needing some time to place your orders. So we are starting that session 15 minutes early, starting at 8:45. It'll end around 9:15, giving you at least 15 minutes to think about what you've learned during that session and perhaps enter some orders before the market. So that's going to start on March 1st. Now, to talk about what we are going to discuss here today. Now, I've had the opportunity to learn about Rick's thesis and his investment process over the past few months. So I'm really excited to share with you some of the things that I've learned from him over the past few months with respect to how he views the markets, the types of indicators that he uses to time his particular trades. And I think this is really important for our members to understand this as you receive more and more research from us to understand how that is created. So today we'll go over at a high level our investment thesis here at OptionsPlay's research team that Rick is leading. We'll talk a little bit about how this investment thesis and this way of thinking allows us to potentially outperform the market and the type of results Rick has seen over the past 5 years using this type of strategy, with his experience over the past 30 years and how that really helps him maximize risk and reward. And I want to talk a little bit about the risks involved with this type of strategy because it can be perceived as risky, but we really want to talk about how it shifts the risk and reward in your favor by maximizing the risk and reward, and then giving Rick some time to really give you a deeper dive into the Demark studies with some real examples that I think will help illustrate the power of these indicators, and then showing you how to access these things through the OptionsPlay research portal. And we'll open this up for Q&A here at the very end. So let's first start off, Rick, by talking a little bit about your investment thesis and this contrarian approach that you have. We've talked about in the session when you first joined us a few weeks ago about your experience with behavioral finance. If you don't mind, if you could give us a little introduction as far as just your overarching process that you use for approaching the markets, and then we'll dive into some of the specific indicators that you might use.
Okay. Well, thanks, Tony. When I started in this business some 40 years ago, I started right out of school and was a floor trader in the commodities exchange. And I learned a ton about trading. Obviously, when you're trading in the pits, your holding period is often 10 seconds. So you learn a lot about how to trade when you have such short holding periods and what the game is like. But as I always had some sense of the charts too. Even in college, I learned kind of on my own about charting and then just picked up more as time went on. But as I made my way to when I eventually left the trading floor a dozen years after having started, and I went to Morgan Stanley initially on the commodity side, it was very clear to me that one needed a very different approach to how to play the markets than what the general pack does. I wasn't interested in being what I call kind of the average strategist or analyst or player. It's never the type person I've been. It's always been much more about being, no pun included, head and shoulders above the rest of the people who do what I do in life. And as I started putting pieces of this idea in my head, I realized that in order to separate myself, I couldn't play the same game. And the same game is the same game that you see people and analysts who are on CNBC every day and Bloomberg and the different channels that you watch pertaining to the markets. Most strategists, most analysts are generally bullish. They give little attention to actually selling stocks. Of course, there's a long-term bullish bias to the market, and that's underlying why these people are generally bullish. But if I came out with bullish calls all the time, I'd kind of be like everybody else. And you just join the pack, and you can't differentiate and kind of make yourself more noted for what's going on out there. So I wasn't looking to go against the crowd just to stand out, because if you're wrong, it doesn't do you any good. But if I could stand out while doing things correctly, going against the grain, selling when people were buying when people were selling, and not just because they're selling, but if I could, let's say, figure out when enough people have sold that we've actually got a much better chance of being near a bottom, that's the time to step in, because the rest of the street's still trying to get out of stuff while you're now buying, along with what I learned over time was also smart money was doing the same thing. So I thought to myself, if smart money is thinking this way, there must be something to it. And although the sell side of Wall Street, the firms that have research departments, so what we would typically think is your classic brokers, whether it's Merrill Lynch or Goldman Sachs or Morgan Stanley or any of the UBS, any of the lots of firms out there, their research is generally trend following research. And I realized that if I could determine when to fight the trend and do it in such a way that there was process and methodology and not just simply taking a wild guess that something was going to stop moving up and go down, you'd really be able to sell the close to the highs of a move and get long at the bottom while the people are still thinking, oh my God, this is terrible. And I develop processes over time. Some I developed myself, some I learned from others out there. But I've been able to put this together in order to actually increase odds of success, which is exactly opposite to what most people on Wall Street would tell you about not buying falling knives. Well, if you can figure out where the knife is just about to hit the floor, you're really not going to take on much risk by doing that. And the same thing when something's flying and it looks great and strategists left and right are saying this is going higher, this is going higher, and I can get enough information together to think that it's actually likely exhausted, I'm going to fade that move. And by the time others realize that was, if I was right, if it was the right move, the market has often turned 10, 20% downward before you start getting other people joining that idea. So when they all jump on board, they're first selling and you've already sold 10 or 20% ago. It's a huge difference in being able to outperform benchmark indexes over time if you can actually do what apparently is the hardest thing to do on Wall Street, which is buy low and sell high. We're all taught to do that, but very few people actually do it well.
Right. And that's really what's exciting for me to host this session here today, is to really pick your brain about your 30 years of experience of doing exactly that, of we understand conceptually buying low, selling high, but how do you actually go about doing it? And that's what we're going to take a deeper dive into here today. And it is a bit nuanced here, because I think for a lot of investors that are familiar with technical analysis, you might have used, popular indicators like some of the momentum indicators like RSI and CCI that might try to tell you these types of turning points, if you will, or moving averages. But the key difference, or the nuance from my perspective, is that those indicators are all lagging indicators, meaning they're looking at historical data in order to then try to predict future data, versus what you're looking at is slightly different. And specifically, not necessarily identifying the start of a new trend, but more importantly, identifying the end of an existing trend. And that nuance, I think, is quite different than what classic technical indicators provide you with. And we'll talk a little bit about this higher odd of success, because, as you say, catch a falling knife. That is kind of the one thing that a lot of investors are taught to stay away from. And I actually tried to look for an image of a falling knife. I couldn't quite find one, but we'll talk a little bit about kind of the probability and odds around this type of strategy. And that really leads us to kind of our next slide here, which is, how can we actually outperform? Because, what you were talking about before, you can still make money from using classical technical analysis and trend following techniques. There's nothing wrong with those strategies. There's absolute return to be made from those types of strategies. But I think what we're here seeking is not just absolute return, but relative outperformance to the market and what the rest of the field is doing. And I think that's truly what's different about the investment thesis that you're bringing to our research team than from anywhere else that I've seen on the streets. And talking a little bit about the performance that you've seen from your trade signals over the past 5 years, and you can talk through some of the existing trades that you're currently making with as an institutional fund manager right now. But you were able to beat the S&P 500 4 out of the last 5 years by 157.6%. That's an average return of about almost 3 times what the S&P has returned over the past 5 years. And Rick, that's some phenomenal performance using this type of strategy. And that's really, I think, what differentiates this type of strategy from most trend following techniques.
So I completely agree with you. I've been a technically oriented trader for my entire time that I've been in the markets, far more so, Tony, than fundamentals. And the classic technical analyst is going to say that technical analysis is used to identify the trend, to play in the direction of the trend. And I kind of always smile when I hear that, because I use it to help me figure out when most people are playing something in one direction. And then I look to see when they're likely wrong, and when it's a bad time to be a buyer in an uptrend, or a lousy time to be a seller in a downtrend. And that's what some of this, using behavioral finance and using some of these models, and when things gel and they kind of come together, we can come up with ideas that are getting into something that's after a straight down market. I'll sell stuff that's on all-time highs and has targets that are 30% higher from the fundamental analyst than where you're trading, and capture sometimes 10, 20% or more decline. And maybe eventually we go there, but there's certainly a good chance that we can make money in between. And that's also, compared to pure buy and hold, that's how you can outperform over time too. Because if you think of this in, let's say, S&P 500 terms, if you bought the SPDR on January 1st each year and sold it on December 31st, you're getting the return of the SPDR. In the last few years, where we've hardly had any pullbacks, it's actually been very good to do, because there hasn't been much give back. So most often, whatever you sold has ended up costing you some money. But in general, there are times that you're going to want to sell a stock or sell an index because there's a pullback coming, and then come back in. You can still play with the long-term trend. So if I'm shorting something into or taking profits on something that I've ridden higher, but I can identify there's a likely top here, again, before it's obvious. This is something that doesn't have to distribute for 3 months. sometimes we can peg it literally to the day or the week that it's going to actually make its peak or its trough. Um, you can then play those moves and increase your return than simply being a buy and hold player. So over time, I'm not saying this is easy, but some people have a gift in life to shoot a basketball from 25 feet away from the hoop and swish it in every time. I can't do that, but this is something that I have developed over many, many years of, we'll say, practice. And I can't imagine how many charts my brain has seen in my 40-year career on Wall Street, and how much you learn and your brain takes in by simply looking at charts with some annotations on there to really teach your brain how to look at things and what the odds are of certain things coming in the future.
Right. And I think that's is really kind of what, for me, has been so powerful with respect to the set of indicators that you use is the accuracy and the precision of that timing down to the day or the week of what is the end of a major trend and the beginning of a new one. And that is what's so powerful about this and some of the examples that we'll go through here today. And when we talk about buying low, selling high, it's really this, the set of Demark indicator and studies that you use to try to time these exact lows and exact highs to get in and out of these trades. And I'm really excited to show, viewers here and our members of these set of indicators. So let's talk a little bit about risk, right? Because as you said, this is probably one of the things that a lot of retail traders and traders in general have been taught, right? We know we want to buy low, sell high, but we also have been taught don't catch a falling knife. However, I want to talk a little bit about what the benefits are of potentially catching a falling knife. What truly are the risks? Because it actually is a way to decrease your risk by trading these types of strategies, the exact opposite of what many traders have been taught. So can we talk a little bit about that as to how you see risk around these types of strategies?
Sure. So let's say you're more in the camp of a classic technician, and you've been watching a stock that's bumped up against an $80 price high multiple times, and it finally breaks out. So you go, okay, I can buy the breakout, and you pay 83, 84, you get the sense it's going higher. If you stop, well, first question would be, where would you stop yourself out? If it closed one day underneath 80, where it broke out from, is that enough to say, oh, this isn't a breakout? I want to get out. Would it be 2 days? Would it be a week, 2 weeks? So it's hard to understand and to figure out where your stop is. And the more you buy into strength, playing the trend, buying an uptrend, the more difficult it is to actually figure out where's the stop that's the right stop, such that if you happen to have lousy timing and when you first get into this trade, how much are you willing to let it pull back against you before you say, hey, I was wrong? And I will tell you that that's often a tough game. It's very hard to determine where is the proper stop. If you have a long-term uptrend that was bucking up against 80 and it breaks out above 80, you pay 83, and now it gets to 79 and a half. Do you really want to get out of this stock that's been moving higher and still has uptrend lines in place, but maybe the most recent breakout, is being questioned? It's pretty hard to come up with where is the right place at which, if you buy with the trend, you stop yourself out. When you're going against the trend, like I do, on probably 2/3 to 3/4 of the trades I do are counter trend. Sometimes I play the breakouts too, but certainly our viewers are going to see lots of ideas that are counter trend, and go against in the OptionsPlay software where you have the 1 month trend and let's say the 6 month trend on the charts, and they might say bearish, bearish. And in the past, perhaps you've been going with selling a call spread or doing something bearish. I may very much fade that and say, I want to buy what looks like a bearish chart because I can identify a likely low. And I know that here I can be much more precise about if I'm picking for a low, I can generally calculate where I'm wrong based upon how that low was made and not necessarily some prior low. And sometimes it is, but there are multiple ways. When you've been trading markets for 40 years, you don't generally stop yourself out where everybody else does in the obvious places. And one of the skills I've also been able to do pretty well at over the years is to not stop myself out where everybody else knows there are stops that are going to be resting. So if something has a triple bottom at 40, you know for darn sure at 39.75, there are sell stops. So I don't want to be a part of that. So I'm either going to risk lower or I'm going to get out before it even trades down beneath 40 if I can figure out how to do it. So if we look at this chart here that you've put up, this was Cleveland Cliffs. This was an idea we put out. In fact, I think it's the first idea that I did for OptionsPlay. I had indicators that suggested that $16 could be a possible low. And I will tell you, I bought this in my own account and I had a resting bid at $16 when this stock was trading in the mid 20s on the hope that if something went wrong, that's the place I want to get in at on, an anomaly type of sell-off in the name. And I had a 1602 bid in for, as I say, quite some time before we got there. So a lot of times too, I will put these resting bids in underneath the market, not close by to where we're trading, well underneath, should we get these, occasional crazy things happen. I did the same with the Rivian. I bought Rivian on the day that made its low. It then rallied about $6-7, came back, made a lower low, but I paid, I think, 56 since it's trading in the 60s and even crossed over 71 today at one point before getting dragged down by the 95-point decline in the S&P. But again, had resting orders because there are certain times you can identify where a likely exhaustion point is going to be before it ever gets there. Most of the time, I do it as it gets there. But in the case of Cleveland Cliffs, I kind of had a feeling that that was the level. And then when we got there, I had other things show up that suggested downside exhaustion, which is why I bought it for myself. And we did that. We sold the credit spread too. And now if you take a look, if you're a player of this name and it's trading at, almost $20, just let's say in round numbers, you look at the breakdown underneath those lows at 19, you had a triple bottom at 19, then shot up to 21 and change. And that day that made the recent high is the day we got out of the second half of the trade. And so what do you do now? Is this bullish or bearish? Your chart's going to say, let's see, from a month ago, we're down. From 6 months ago, we're down. And yet we have a spike bottom that's come right back up to where we broke out from. This could easily be a place that picks up more value over time, or it may fade, but it's a lot harder for me to play Cleveland Cliffs now than it would be when it was at 16. Now, if I'm long that name at 24 and it's trading 19, 18, 17, 16, I'm probably puking the stock out, saying this was a bad idea. It's taken out a triple bottom. I don't want to have anything to do with it. And that's exactly what I try to do, is collectively figure out when the street is dumping out of a name to a level that I actually think is a good place to come in at based upon the models and the collective thought process that goes in behind this. So this is not something that you pick up after, being in the markets for 2 years or 5 years, maybe not even 10, don't know. But it's a life's work of, all post-college, I have been in the markets. So it's a life's work of being able to kind of play this. And I make plenty of mistakes. I don't want anybody to think that I don't have some bad losers in there. I do. But generally, over time, I've been able to outperform the markets and take an approach that really does differentiate me. And that's why I have the institutional clients I do as a consultant to many hedge funds and long only. Long onlys are generally the industry name for, let's say, a mutual fund. I have institutional clients, and I realized several years ago it made sense to open up the In the Know Trader website that I have, which does a subscription for individual investors doing the same type thing. And it's, it definitely is a different approach than most people take in this business.
Right. And I want to, and I think it's important for us to discuss that at length. So we're actually hosting another session tomorrow morning to discuss kind of the daily play signals that Rick sends out and what you can expect from them. But today is an important discussion to help you understand this counter trend investment thesis, because as we've received some questions from members asking us why we're taking a bullish position in what is a stock that has currently been in a bearish trend, or vice versa. Why are we taking a bearish position in a stock that currently is in a very bullish trend? Keep in mind that the 1 month and 6 month trend that you see on your screens on OptionsPlay, these are trend indicators based on historical data. So it's telling you what has happened in the past. It is not a prediction of what's to happen in the future. However, our daily play signals is a prediction of what we believe might likely happen in the future. And that's different between the two. So what we're trying to say here is that stocks that are severely bearish have actually a higher opportunity of bouncing higher. And that's why we would take a bullish position in a stock that is currently in a very severe bearish trend, and vice versa, why we might take a bearish position in a stock with a very strong bullish trend. So that's just hopefully helps clarify some of the questions. We'll come back to this question specifically on our session tomorrow morning at 8:30, 8:45 a.m. Hosting tomorrow morning, Rick and I. We're going to dive more into kind of the daily play signals and what you can expect. And Thor is asking a great question. And Thor, we're going to get to it. He's asking, well, how do you actually go about doing that? And that's really kind of what we want to talk about, Rick. You know, your life's work effectively over the last 30 years using these institutional timing models. And I say institutional, even though it was available in theory to retail traders. Just the fact that the indicators that you're talking about are quite expensive and not available everywhere. I think it largely has been in institutional circles that have used this indicator. I've been a technician for 16 years. I've learned about these indicators. I haven't really used them much before talking to you a few months ago and starting this process of learning about them. But really kind of what's quite truly different about them is that most classic technical indicators, or largely what I would call all technical indicators, are what we consider lagging indicators. Even the ones that are quote unquote named leading indicators, they're really lagging indicators because they're looking at historical data. Versus, Demark Studies is really looking at price action, which truly is the only leading indicator, and it identifies exhaustion, which I think is quite nuanced in terms of how different it is to a trend confirmation or a trend reversal. So today, we're going to give you the time to talk a little bit about the Demark Studies, specifically the sequential setup and countdown, and how you use them to actually implement what we've been talking about here. Because I think everyone understands in theory, yes, buying low, selling high, that's how you can maximize performance. That's how you can minimize your risk or reward. That's how you can outperform the market. But how do you actually do that in practice? I want to give you the floor now to talk about the Demark Studies and how you go about doing so.
Okay. So one of the things first, let me tell you who Tom Demark is, because many of you don't know who he is. Tom came into the industry in the 1970s and created this model. This is before we had computers. So what I'm going to show you is stuff he developed in his head. He saw it. So I give him just an incredible amount of kudos and applause for being the type of person who's got a brain who can look at relationships between price movement, price bars, and actually figure out that there's a rhythm and a pattern to the madness of what trading and how markets move is over time. And he ultimately got invited to Goldman Sachs by Lee Cooperman, who, for most of you who aren't close to my age and are much less time on the street, you'll still see Lee occasionally come on CNBC. He's the head of the hedge fund called Omega Advisors. But Lee was the head of trading at Goldman Sachs equity trading for a long, long time. A partner there, made a ton of money and has been very, very successful over time. And he had hired Demark as a consultant, and eventually he wanted him to come to to Goldman. And Tom didn't want to work for any company. He wanted to be on his own. And he eventually got some of the biggest names in the industry to start following his models. And he made some outlandish predictions at the time that very often to the day, he predicted the correct turning point to a trend that would never have been obvious in any other type of methodology that was known. So when Tony says that these are institutional models, they are. And let me give you a little clarification on this. There's only really two platforms that this was built on. One is a platform called CQG, which is when you see my charts that are now put into the daily play. Those come from the platform CQG. Tom originally had them do all the coding on his models, and they were the only people who had it. And then back in March of 2000, I actually brokered the deal, let's call it that way, between Bloomberg and Tom to get his models into the Bloomberg system. At that time, I was the head of futures, commodities, and technical analysis at Bloomberg. And I had met Tom years earlier, and I was able to convince both parties to work together. So Tom put his models into the Bloomberg system. And for 11 years, up until 2011, anybody who had a Bloomberg had access to these models for free. Since 2011, he has charged $500 a month on top of the price of a Bloomberg to get these. And if you have CQG, you had to pay also an additional $500 on top of their charting system to get Demark's models. Those are the only two platforms that officially Tom has worked with for the institutional crowd in order to have access to these. And they're the only two that it would still say are the ones to use that have this coding down right. There are a couple of platforms that have tried to code these, and they get some of it right and some of it wrong. And to me, if you're trying to catch a falling knife or sell something on all-time highs, you don't want it to hopefully be correct. It better be correct. It's hard enough still getting it right. So those two platforms are still the only place really that are at this point truly reliable to get these type of information. So if you have a Bloomberg, which could run you $25,000 a year, give or take, not including Tom's stuff, or CQG, which is probably closer to anywhere from $1,000 to $1,500 a month. This is expensive software and really designed for the institutional marketplace, and of course for big companies to be paying the bills on these. It's not intended for individual use. That being said, we are giving you the ability to see these signals as I see them. They will not be built into the OptionsPlay platform because they can't be. Tom has to approve and work with any person. And again, there's only two places this is available. But let's see, Tony, if I take over the screen now, I'm going to share my screen. And I'm going to drag this over to a different screen so I can still see you. And let's see, this will stop. Yes, I'm going to continue. And okay. So let's start off with, here's just a chart.
We don't see your screen just yet.
You don't see it. There we go. Now do you see it? Okay. Good. Okay, here is a chart, a daily chart from the CQG platform of Merck. And this is, well, market's closed. So, through today, this is where we closed right here. And you can see that I've spread out the range because, it's been a fairly tight range when you look at it over the last year or more, almost 2 years. Now, it doesn't mean that the stock doesn't go from 84 to 72 percentage-wise. It's okay, but it's not like any of these other high flyers. So this has been mostly trading range. And if you were to put up moving averages here, now this is a 200-day. This is longer than I'd want to look at, but by default, I have, let's say, a 200-day. The street often looks at a 50-day and a 200-day. To me, I only look at those two because that's what the street does. And I want to see what people are likely doing, right? So you hear all the time that, something broke its 200-day moving average, it's going to fall. Well, yeah, there's plenty of people who will sell because of that. Why is 200-day anything special? It's not. Is 202 different? Is 200 days? Is this back test? Is there anything that says that 200 is the right amount? No. It's just about 40 weeks worth of price action, and it just became accepted over time as one of the things to look at. So if you look at this, you see, you've got a fairly flat 200-day. You're just rotating on either side of it, and occasionally the 200-day. So if I bring my cursor here to the left side, we stopped a few times in April and May and June of what year? That was 2020, right against it, but eventually it went through, and then it stopped here a little bit, but then it went through and up and down, blah, 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 blah. This is what you have to deal with, kind of in a market that goes nowhere. Let me put on the sequential model now. And what we're going to see are lots of blue 9s and some red 13s. And let me explain to you what this model is, how he came about, the development of it, and what it means, and how we play this. So I'm just going to zoom in a little bit. What Tom realized over years of looking at markets is that if I were to ask you, and kind of answer this in your head, how much does a stock have to move up before you'd say it's actually trending higher? And if I ask 10 different people, I'm likely to get at least 10 different answers. There's nothing even in the textbooks, to say what makes a trend other than an uptrend is higher highs and higher lows. Beyond that, you don't really have much information. What Tom realized was this back in the 1970s, that when a security moves, and you might want to write this down, 9 consecutive price bars. So if it's a daily chart, it's 9 consecutive days. A weekly chart, 9 consecutive weeks. A monthly chart, 9 consecutive months. And if you're looking at a 2-minute chart, it's 9 consecutive 2-minute bars. 9 consecutive price bars that the closing price of each price bar is greater than the closing price from 4 price bars prior. So 9 consecutive bars that the close is greater than the close from 4 bars prior. That's the minimum upward movement you need to see in order to call, or at least say there's possibility of trend in that direction. And the inverse, if something's selling off, is 9 consecutive price bars that the close is less than the close from 4 bars prior. When you have that, you've often moved the minimum amount you need to say there's potentially more trend coming. And each time you see a blue 9, Merck has traded either up 9 days in a row. I take that back. It's not that it traded higher. It's that each one of those 9 days closed prior than the close from 4 days earlier. Right? So you can have a down close along the way. I'm not saying you have 9 consecutive higher closes. You have 9 consecutive closes that the closing price was greater than the closing price from 4 bars earlier, or beneath the closing price from 4 bars earlier. So here, let's look at September of last year. Stock sells off, and the software does this in real time. So it identified this particular day closed beneath the close from 4 days prior. In real time, the day before this had closes above the close from 4 days prior for a couple days. But as soon as it goes in the opposite direction, it doesn't care about whatever 9 count you were in the midst of until you get to a full 9 count. When it sells down to a 9, it means, so here in mid-September, you would close 9 days in a row, close less than close from 4 days prior. That's the minimum amount needed to say there's potentially downtrend. Otherwise, everything else is kind of wishy-washy in his term. That we did not extend beyond the 9 count, and this happens frequently. The 9 count actually ended up, it didn't call for a low per se. We know over time that stocks and bonds and commodities price movement often stops on this particular pattern. It then moves up for a few days in a row, but one of these days in here closed less than the close from 4 back, so it killed that count, but eventually then we got a 1, 2, 3, 4, 5, 6, 7, 8, 9. Now it does 9 in the opposite direction. 9 days in a row, you closed above the close from 4 days back, and you had a near-term top and a pullback all the way to the 200-day moving average. And when you have a flat moving average like this, I'd expect lots of these type false signals and false breakouts and things that, look, on this day, bar 9 gapped up strongly and created the ninth bar. If you're a typical technician, you're looking at all these highs in here over the last few months and you go, oh, breakout, I'm a buyer. Well, you might have bought it, but it took you a month to break even and to actually start making money on this. In that time, it pulled all the way back. It then does another 9-count higher that is just a couple days before the high, before this sells all the way down and makes a 9-count down. The 9-count is called the setup portion. So I'll use a capital S, and it's the setup count. So if I say that we're in a setup +7, that means we're plus, meaning above the price bars, the count is coming in an upward movement. So if I say we're on a setup +7, you know that I'm thinking about in a couple days, we're going to possibly hit a +9 and maybe a stolen trend. And the same thing on the downside. If I say we're on a setup -9, you know that we've just sold off 9 bars in a row of the close less than the close from 4 bars prior. By the way, Tony, I'm not looking at the chat right now in case there are questions coming in. So we'll get to those at the end. So I want you to. Now, when you do here's a good example. When you do a 9-count downward or upward, but I'm going to look at the downward one here. Now the market has moved enough to say we've potentially created the beginning of a trend. And the 9-count is often the inflection point because it's either going to keep going. And if it keeps going, we're then going to look for the exhaustion point to that setup count. What is the exhaustion point to a setup count? The rules are different here. We're going to count now. Now we're into what's called the countdown portion, the red count. This is in the case of a stock going downward. Once we do a 9-count, we're going to look for 13 days that do not need to be consecutive, like the 9-count was. That the low of a day is that the close is less than the low from 2 bars prior. So in the setup count, we were comparing close versus close 4 days back. We're now looking at the close less than the low from 2 bars back. When 13 times after I get a 9-count, I get a close that's less than the low from 2 bars back, I often have exhaustion of trend. And that's when I'm going to see a 13. So 1 day before the low, this identifies downside exhaustion to this move. Now, sometimes we could go sideways. So remember, and this is important, there are 3 trends in the market: up, down, and sideways. If you had been moving upward and you then go sideways for a certain amount of time, you have had a trend change because you're no longer going upward. And what this model was designed to do was to identify the likelihood of a trend change, or at a very minimum, what Tom would tell you is that this model was designed to tell you when not to play and put on a new position in the direction of the current trend. In this case, it would tell you, do not put on new shorts or do not be selling stock any further. You potentially have a place that the market has exhausted itself in this direction and could go back. You should get a better, if you're looking to be a seller, you'll have a better place to be a seller than at this point down here. This 13 count is a weird one and one I don't usually take because it's trying to finish off actually, this shouldn't even be here. I'm looking, let's see, low. Oh, yeah, I never properly broke. All right, so this 13 here is 13 times that the close was above the high from 2 bars back. Why am I looking at close above the high? because this 9 count said you're potentially in an upward phase, and the system, the model itself, the software is going to look for that unless certain rules get broken, which would tell it we've sold off too much. There's no reason to look for an up count to exhaust this 9. In this case, because this dotted level, and I won't go into this today, wasn't properly breached on the downside, even though, yes, we closed beneath it, but there are rules on how you have to close. The software still says we're looking to finish the exhaustion point to this 9 count, and it showed up here. But considering the high of the move was here, I'm unlikely, with all my years of experience, to pay much attention to this 13 as being an exhaustion point, because it's way lower than where the 9 even came in. Let me here. I'll just pull up some other charts that I had looked at to give you a sense. Oh, I know what I'll do. Let's do it this way. I've got some of these in here. Here's the Russell 2000 on a daily chart. Now, in this case, you'll notice they're not red 13s. They're still blue 9s, but I've got kind of some purple 13s. Well, there are sister models to the sequential model. So there are different ways of counting through 13. They're all very similar, but there are different models. And I bring this up because I do want to show you this is not always going to be correct. So if we go to the far left here, we started a setup count in September of 2020, and this is a daily chart. So we had 9 consecutive days that the close was above the close from 4 days back. Notice we went sideways to downward for several weeks before this resumed going higher. Actually, this is combo, so this counts differently. I haven't told you how that counts, and it's too complicated for this initial one because I just want to show you how this model works. We'll get into more of the details besides just standard sequential and other types of in other future webinars. During the whole sideways portion for much of 2021, I had a 13 on the high in February, exhaustion of trend. 9 in the opposite direction, 9 somewhat near the high in the opposite direction, 9 here on a high, it pulls back. A 13 on the 2 days before the all-time high, a 13 exhausted the other way in December for a bounce from 210 to 225. And now we also bottomed shortly after the 9 count and have kind of gone sideways to mildly higher since. If I switch this to a weekly chart, notice in the past, now here in 2019, 13 and 9 kind of coming at the same time, beneath what was the all-time high at the time, possible place to do some selling. You don't know for sure, you never know for sure, but you know that more people are leaning for this to be a breakout than not. Now, in December of 2019, there was already talk of this thing called COVID in China. It hadn't quite hit here, and you can see it was February and March where the COVID sell-off really happened. But this was already identifying the potential for an exhaustion of trend. This 13 here was early, but if you look at where it came in, since then, yes, it definitely went higher, well higher. So not all of these are going to work. And now, of course, we've sold off and we're beneath, the bottom end of what the range had been. So I'm not going to say this was a good one, other than it kind of gave you a sense that you weren't going to have the same leaps and bounds to the upside as what had occurred previously. This works in all different time frames. So I want to put up, here's the Nikkei on a monthly chart. And if you go back, so this is all the way here on the left where my arrow is, this is 1995. Setup 9 down leads to a setup 9 up. 10 months after this 9 down, you have a 9 up. 9 consecutive months that the closing price on the last day of the month closed above the close from 4 months prior. You'll see lots of turns on 9s and 13s. It's why we pay attention to this model. Now, it sounds like from what I described that this could be a very easy model to code, right? 9 bars, 9 consecutive bars, either direction, close above the close, or close beneath the close from 4 bars prior, followed by 13 bars, need not be consecutive, close above the high 2 back, or close beneath the low 2 back. It's not as easy as that. Many people have tried to do this. The problem is there are lots of nuances to the coding. I gave you the most simple, basic definition of this, but Tom purposely created where you cannot replicate it. There are things that are inside the code and certain relationships that have certain filters that you will not get success. You can get close, and it may be better than nothing. At the very least, I could tell you, if you are a coder, you could learn how to program, certainly the 9 counts. Those are much easier to do. It's the countdown portion, the 13, the count towards 13 is that have multiple nuances built in that you're not going to be able to replicate the same thing. Here's the US 10-year. This is TNX. Right now, this 13 in here, I would not have taken at the time because it was in the midst of a 9 count, the earliest I would have bought. And that, of course, means selling bonds because this is the yield chart. The earliest I would have bought is on the 9 count. This 13 is a good bottom for half a year. The all-time low made on a setup 9 on a weekly count. We played this 9, we played this 9, we played this 9, and now look, everybody's saying yields are going higher. And in the bigger picture, they are. Here, if I put up a trend line, here's an inverted head and shoulders, right? Here's your left shoulder, here's your inverted head, and here's your inverted right shoulder with even a second shoulder. This is broken out. The long-term bottom is in place in yields. Everybody thinks yields are going higher. But right now, I've got a 13 and a 9 count on the weekly chart. Hold on. Excuse me. So I've been talking to institutional clients this week saying, hey, if you want to kind of fade the move in yields, because it's a very one-sided trade, find me somebody who you hear on CNBC or Bloomberg who thinks bond yields are going down. I've heard 0 people tell me yields are going down. That's the perfect time to potentially fade the recent up move. Now, do I think we're going to have a massive decline in yields? No. I think I respect this downside breakout pattern. But could yields go from 205 back to 185? They could. If you're a trader, I'm not saying they will, but if you're a trader, something you consider. Let's see. And look, I can show you this across different. Let me see, TNX combo and aggressive combo. Okay, so I'm going to put up one of these sister models called combo, also counts towards 13s. So this is a daily chart. So at the time, this was probably an all-time high in November of 2020, 13 on the high with combo. You can see some 9 counts captured nicely, highs or lows. This 13, not particularly good at all. Now you got a 13 on the bottom here. Maybe a bottom, may not be, but I'm also, use standard technical analysis. Look at, highs here, triple, quadruple highs somewhere around here between, I'd say 50, where is that? 59, 59 and a half. And now I've got some downside exhaustion. And we're in an 11 count on the other way of counting. So we certainly could be getting closer. This is how you take price moves that go against the grain. If I was just a standard technician, I could say, this is where it broke out from. I could maybe buy here. And if I put up, let's say, RSI, we might be oversold. Yeah. I could come up with a reason to do that. But knowing that there's a sequential or a combo of 13 there, or sometimes 9, ups my confidence that this really could be the time and place to do a play like we put on. Look at, here's a weekly chart of, I'm going to take off aggressive combo. I'm going to put on sequential. All right, here's a chart of CVS, the drugstore that's on everybody's corner. Not only do we see certain 9s and 13s that have worked well, but just recently, right, 2 weeks ago, we have a 9 up that had just followed this 13. Again, this 13 I'm probably not taking because we were in the midst of a new count, so I'm probably going to wait for the 9. And you peak at 110 and the stock's trading 102, you're down almost 8% in 2 weeks. The stock market is not down 8% in 2 weeks, but this is, and it's just, again, it's a way that the whole street says, what are you doing? This is a bullish stock. It's got, I don't know what its price target is, but let's say it's 130. Why would you be selling at 110? Well, because right now, for time and place, it tells me I have a chance that if I'm wrong, I'll know fairly quickly because we'll keep going higher and I'll lose a few bucks. If I'm right, I'm ahead of everybody who's thinking, so if you bought in the last month, you go, okay, well, I'm not making any money and I'm not losing much, but I'm not performing. As if this breaks under 100, you're going to have some people going, I just paid 105, stock's down 5%. Oh, but don't worry, the analyst says it's going 130. Well, this could easily get down, if we really get some type of price correction, this could get down to the low 90s. And while everybody's twiddling their thumbs and what to do, we're in theory, making money and way ahead. Now, imagine if you started getting downgrades or there was some bad news, what the stock would do. So this is part of, Tony, the reason why I look at the markets the way I do. I can, the software even gives, when you have a 13, the software even tells you where the 13 would be wrong. And that's often, here, let me take something away so you don't get confused with lines. In this case, when we had this 13 here back on the left-hand side of the screen, it said if you properly get above this line, which is, it's what we call the risk level, it's the risk associated to being a seller here, then it's no longer a good signal. Well, look at the difference between where it went to versus what you were risking, and eventually you get stopped out. But to me, you might be stopped out, but if you sold the stock here at 75 and it had fallen to 55, I'm not really paying much attention to what the stop out is. It was a huge type of victory along the way. But breaking through that would tell you, okay, you were wrong. And there are times you break through these levels. So from the recent 13, it said that if you got above 106.52 properly, you would get stopped out. The fact that this dotted line hasn't turned solid is the software telling me that even though it broke above, it didn't break above in the proper rules that Demark created to have a breakout. And therefore, the 13 is still intact, as is the recent 9. So it's part of playing this game. And I want to show you too, before I turn it back to you, Tony, just in talking about this, let me see if I have it up here. Yep. This is S&P futures on a 5-minute chart. I just picked a really short-term chart. Imagine trading signals with something like this too, intraday. And if you go, well, Rick, you picked 5 minutes because you looked at the chart and it happened to work well, we'll find. Tony, give me a number between 5 and 60 minutes.
Can you do custom ones like 33 minutes?
Yep. Here's a 33-minute chart.
Notice
now,
how
that
the
doesn't,
13s.
if that doesn't show how robust this model is and how turning points. Now, I let you pick any time frame. And we can even go, let's pick a 139-minute chart. Highs here, this gets you a bounce, at least a trading bounce. Some of the 9s are good. They're not always going to be good. 13 sale here. 9's a little early here. This 9 got you a decent bounce. And now you're into a 13.9. But, well, I don't know if I would take this one because the risk all the way down here at 43.02. I don't want to have to risk 70 points on it, short-term trade. But the point is, you pick any time frame. This model is incredible. And there's a reason why you got to pay the bucks you do to get your access to it. It's not for everyone, but It helps give you an edge. And it is not, and I could not repeat this more strongly, it is not the holy grail. There is no such thing. There are times you're going to get your rear end handed to you because this is just going to keep printing 13s and you're going to just keep going higher and higher and higher. Look at the daily chart of the S&P with a year like last year. How many times do we see 13s? Sometimes you go sideways from them. This 13, you go sideways for a few weeks. This 13, I wouldn't have taken till the 9. Let's say this 13 worked, and this 13 was very good. But there are times that you will just roll. I remember the late 1990s where you had a bull market like this too, when technology was just carrying the day, and 13 after 9 after 13 after 9 kept coming. And if you played them like that, you got really hurt. So you also have to understand what mode the market is in, what's going on in the macroeconomic scene. You don't want to fight the Fed. When the Fed's kind of just pumping money into the markets, I may not care as much about daily 13s. I may look more at weekly or monthly because the near-term stuff may be too minute for me, but I kind of want to get the bigger picture right. And you can do this for pair trades too. I can look at here. Last summer, I upgraded energy. Was that a weekly, daily? So here in November of 2020 was the all-time low of relative performance of the XLE, the Energy Spider ETF versus the Spider itself, right? So if I pull back 20 years here, you will see that was the all-time low. And energy outperformed in a pullback. And right here is when the 8 and 9 count, I was already looking for it by bar 3. I was already telling my clients, if we got to an 8 or 9, I'm going to be a buyer because I believed that that low was going to be, for other reasons, the bottom in relative performance, that energy would actually be a sector you want to be in. So I upgraded the sector right at here on August, I think it was August 15th. And this has been the performance since. So you can use some pair trades too. And again, I'm not doing this to sell Tom Demark's products or anything like that. Now that I am part of your team and putting out calls each day and writing the research reports and doing the webinars like I am, I want you to understand how and why I'm coming up with the ideas I do. I don't trade every 9. I don't trade every 13. It has to mix into other things I'm seeing. But if I have a macro idea that I think is the right idea on how to play something, and then I get these models to line up, it greatly increases my confidence that what I'm doing is the right thing at the right time. And this is really about timing, because it doesn't tell you what level to play. It tells you when to play. And that's the huge advantage that those of us who incorporate this type of work into their methodology have over the bulk of the street that knows nothing of this. So,
well,
Tony,
thank you so much, Rick. I think that was a very powerful explanation, and really, from my perspective, the tip of the iceberg in terms of the work that you do and the power of the Demark studies with respect to timing the markets. As you say, there are a lot of nuances in this, and we're going to spend more time over the next few months to kind of dive into this a little further and talk about some of these setups and how you use them, and some of the examples using the daily play will be used to help illustrate this. And I just want to use one, if you don't mind, Rick, can we look at Morgan Stanley, because that was the daily play from today. And you found Morgan Stanley using this exact same setup. So if you don't mind, let's look at that Morgan Stanley trade and kind of how you came about finding this and what the charts look like.
Yeah. So this is my old shop. I look at this chart and it reminds me a little bit of the IWM, the Russell 2000 chart, because for months, we were basically in a trading range, something like this, that got a breakout to the upside and then quickly came back into the range. This is just like the Russell did. And I look at where did we fail? This 13, that goes all the way back to October on the daily chart, the risk level on this one was actually at this level of 110 and change. Where did we get up to? 109 and change. And then we came right back in. I also looked at Bollinger Bands. And I said to myself, now, yesterday, we said today to sell a 102, 109. And I was thinking that we could get down to the bottom Bollinger Band or play with this level, or possibly even come out the bottom end the same way this, fake people out on the top end, we could do it on the bottom end. I really didn't want to see it happen in one day, because not only did we not get entry into this, but it's kind of, unfortunately, a missed opportunity with how fast the market's moving right now. But part of the idea of the trade is we're essentially flat. You get this fake breakout that comes right back in, and ideally, even if I was going to put this on now, I don't think I'd sell it much lower than even the mid Bollinger Band. If I was going to do this play in the future, I probably look at, and part of it's going to be, does this sell off, do a 9 count on the bottom, and then turn right back in the middle, in which case I'm not sure what I do, because this is mostly flat. I wanted to take advantage of my thought process that stocks are not going to make new all-time highs. And I've said this now for quite a while, especially because of credit spreads widening out. And a couple of weeks ago, the in-the-know traders weekly play was to play the widening credit spread through ETFs. And I think with credit spreads widening out, the likelihood that any of the 3 major stock indexes are going to make new all-time highs anytime soon is very remote. And therefore, I don't mind selling, some strength or things that look like they failed. That's where I kind of came up with the Morgan Stanley idea. But I don't like seeing something go from one band to the next band in a day or two. It's very fast. We could look at this let's see if we turn this to a weekly. So there hasn't been, the last time we had a 13 was here. So there was nothing really on the weekly. It really was just the false move up that came right back in. And we actually, we closed right down here. Let me take the rectangle away, and there's where we are. So it's been a really bad week, and you've basically given back the whole, sideways. You've now traversed the entire sideways pattern in a week.
Right.
But that's where I came up with it, Tony.
Right. So let me take this back for 1 second. I do want to share with everyone here, because we do want to answer some questions. There were some fantastic questions, and I do want to give Rick a few minutes to kind of address some of those questions. But just to reiterate, you have access to Rick's research from these types of models with our OptionsPlay research, which is part of your OptionsPlay subscription. If you have never heard of OptionsPlay before, you can sign up for a free 30-day trial at optionsplay.com. It's going to give you access to Rick's weekly global macro research, which is the research piece that he puts out every single weekend that you're going to receive on Monday morning, giving you his bigger picture views using these models, the S&P, the Qs, the NASDAQ, interest rates, the commodities, all of these markets that we track as equity traders to influence our views here in equities. You're going to get that download every single Monday morning. You're going to get daily research ideas like Morgan Stanley and Cleveland Cliffs through the daily play ideas, which we will host a webinar tomorrow morning at 8:45 a.m. So hopefully you'll be able to join me and Rick. We're going to dive into some of the changes we're going to be making to the daily play signals, giving you better understanding as to how to utilize them for your own portfolio. And we're adding macro ideas. The idea that Rick just showed you with XLE, these are long-term views that he expresses in the market. We're going to be adding some of these macro themes to our research and the ideas that we put out. So please join us tomorrow morning. We're going to discuss some of these changes, but these are all included as part of your OptionsPlay membership. So if you have a free trial, becoming a member will give you access to everything. If you currently don't have a free trial, you can sign up at optionsplay.com. So with that, Rick, thank you so much. I do want to address a couple of questions here. There were a lot of questions regarding, can I use this for futures? Can I use this for different markets? I think what we've been able to show is that overwhelmingly, and this is really one of the huge benefits, in my opinion, of technical analysis, is that you can apply the exact same method that you just showed us on the daily and weekly charts to just about any single market that has a price and any time frame that you want. So whether you're a day trader and you're trying to scalp these markets, or you're a long-term investor and you are looking for long-term views, you can use the same set of indicators that Rick is showing you across those markets.
And also put into, when you're thinking about this, and again, this was in no way intended for you guys to go out and try to find the software. The thing is, these are inputs. Everything is an input, and there's nothing that I certainly have my toolbox of what I consider my most important inputs, but it's never one thing. And a 13 alone is not likely going to be the reason I go against something. I need several things to line up if I'm going to stick my neck out and catch a falling knife. And so even as Tony talks about, if you're going to trade, these are tools you can use to, trade futures, gold futures on a 10-minute intraday chart. You can, but this is not about you going out and getting the software. This is about you understanding. There's some, as I've joined OptionsPlay, you certainly might have noticed over the last week or two that some of these trades are counter trend trades. It says bearish on top on the chart, and we're going bullish. And you're going to see these. This webinar was so that Tony and I could introduce you to the type methodology I use and why I do what I do. So, I think less about this in terms of for your own personal trading as compared to understanding that when we give you a trade idea, why we're doing what we're doing. And Tony and I talk, every night, multiple times a day. And we converse and we come up with ideas, and we check and balance each other so that when we come up with something, it's something we both agreed upon. And this is you getting probably your first look at something you've never seen before. Even if you've traded for 30 years, you probably haven't seen a model like this. And it's been kept, insular and by the institutional community purposely. But it's why often institutions seemingly have some type of edge. It's just one of many things they have at their fingertips. But those who have decided to go and learn about these models, and this is one of Tom has at least 75 models that are trademarked and that he quote owns. This is just one of them. So there's a whole slew of things that one could look at on top of the normal technical analysis they do, and you'll be able to see some of these ideas get developed as we put out our plays to you and the macro research I do on a Tuesday morning.
Yeah. So thank you so much, Rick. I really appreciate you taking the time out here today and doing this deep dive into these indicators and explain why we are taking some of these counter trend trades and more importantly, the process of which you go through to try to outperform the markets and have been successfully been able to do that over the past 30 plus years and being able to access this research for OptionsPlay members. So thank you so much, everyone, for taking the time out here this afternoon. We are, again, back tomorrow morning at 8:45 a.m. I hope that many of you will be able to join us. The daily play trading signals, there's a few questions about where do you access them. If you currently have a free trial or a subscription here to OptionsPlay, you will receive them in your inbox. You can also access them through the platform. So when you log onto the platform, the first pop-up each morning is going to be your daily play. But we are making some changes to the daily play, so please join us tomorrow morning at 8:45. We're going to discuss some of those changes, some of the improvements that we're making based on the feedback that we have received from you guys. With that, thank you so much. I hope you guys have a great trading day. We have both the recording and the slides from today's session that will be made available to you in about an hour or two after we finish here today. So thank you so much. Looking forward to seeing you guys tomorrow morning. And like I said, this is just the tip of the iceberg. There's going to be far more sessions like this that Rick and I will be doing. We're actually hosting one in the beginning of March. We're going to be talking about Ichimoku clouds and kind of how Rick uses those for his research in addition to the Demark studies. So you're going to be learning more and more from us over the next few months to understand more about how we view the markets. With that, thank you so much. Have a great trading day, and I'll see you guys bright and early tomorrow morning.